Okay traders, so finally we are here. We have the Elliott Wave 2024 video outlook ready for you. Like each year, at the end of each year, we provide some content of what we think it may happen in the upcoming month. So if you are new to our YouTube channel, make sure to subscribe to our channel and also make sure to leave a comment below this video, because you will be able to win the monthly membership or maybe the 12-month membership of our services. So leave us the commentary here below this video by January 14, 23:59 Central European Time, and later in January we will announce these two winners. Okay, also if you want to explore our offers already now, we have the 12-month membership prices ready. And also, if you're not really sure if you want to take advantage for the 12-month package and just want to see if maybe for 1 or 2 months of this service is suitable for you, then check out 2-for-1 offer, meaning you will get 2 months for the price of 1. So make sure to check this out. Okay, so what we will firstly take a look at are ratios. Why ratios? Well, because I really like to compare different assets between them, because this way we can easily see which market is outperforming and which is not. So in such case, we can also identify the Elliott Wave patterns on those ratios, meaning that this can be a very helpful tool to understand in which direction market could move in 2024. Okay. And later in the second part of this video, we will also look at some of the wave counts as well on the particular assets. Okay, so firstly, what we have here? Well, we have dollar index versus the 10-year US notes. So what we are seeing on this ratio, to give you an update from last year, well, last year we were actually anticipating and highlighted a top in place of this ratio. So what we expected is that dollar will be seeing a move to the downside, while notes could potentially be bottoming, because we thought that the US yields are going to see end of this rise due to the hawkish cycle by the Fed. So now when we are seeing that actually Fed is trying to forecast potential rate cuts for 2024, now there are even greater probabilities that 10-year US notes will continue to the upside and outperform the US dollar, which is on the back foot. Now, looking at this updated chart from last year, we can clearly see that so far we have seen only one leg to the downside from that highs, and then a reversal here, a bounce, has only been temporary. And now when we are seeing that US yields have potentially topped out, which I will also show you with the charts later in this video, we can expect that the US notes will see even more gains. So in other words, I think that the US notes will continue to do much better, while the US dollar will obviously, because of correlations, will stay in downtrend. And based on the Elliott Wave principle on this ratio, we are expecting third leg of decline. I'm not really sure if that will be a very strong decline, to be even some kind of an impulsive weakness for the dollar that will be shown everywhere, or will this be only a temporary part of decline, meaning that at some point in 2024 or maybe later at the start of 2025, we will see some kind of a bottom. But for the idea for now is that the dollar is looking weak, and that this ratio suggests that there is plenty of room for US notes to outperform the US dollar. So we are even looking for a potential retracement all the way back to these swings from 2017 through 2019. Okay, so this chart suggests that the dollar index should stay under pressure. Now let's go to the next slide. Now here we are looking dollar index versus the S&P 500. Now clearly, as you know, stock market has been in a bull period for forever, and we are actually seeing the S&P 500 trading near or around these all-time highs. And obviously why this is happening, because dollar and money itself is losing value because of printing and because of inflation, obviously. So we are keep seeing that the S&P 500 should stay in uptrend relative to US dollar. And looking here at this chart, we are clearly seeing a very nice ongoing downtrend, which in my opinion will even resume through 2024. And we have actually been looking for this potential resumption to the downside based on two different interpretations that we highlighted at the end of 2023 video. Now, if we take a look on the next slide, this is also very important, is gold copper ratio. So what is actually a gold copper ratio? Is indicator for economic health, because copper obviously is used a lot in manufacturing and production. So obviously if economy is doing well, we are going to see that copper could potentially see more upside in value because of demand. And what we are seeing on the other side is gold could potentially lose some value, because if there are not economic concerns, it means that investors will not be looking for any kind of a safety like gold. Okay, so if suddenly, let's say that economy will return into the good shape, what this may cause is potentially we may see more weakness here on this gold copper ratio. Okay, now from an Elliott wave perspective, this ratio certainly suggests that we could see move to the downside towards the lower side of this current cycle, as suggested by red line. So I'm looking for potentially move to the downside here, meaning that copper could actually maybe do very well in 2024. Maybe not at the start of that year, but I think that later in 2024 we could see some kind of shift here on commodity sectors. Now also keep in mind that this has very nice 5 waves down here, so that's why I'm also expecting that this ratio could potentially move to the downside. And on the other hand, obviously this could be supportive for stock market, because stocks are already recovering. And if we'll see even more upside, and if we'll see a breakdown here on gold copper ratio, this could be positive even more for the S&P 500. And here's the chart again, going back to 2023 video update, when we were talking about this potentially a cycle that could bring this gold copper ratio lower and would be supportive for the S&P 500. So gold copper ratio is still not moving to the downside, we are seeing sideways. But if that would be the case, it would be even more bullish for stocks, because we are already seeing stocks breaking higher, obviously. Now let's take a look also on this one, which is the S&P 500 versus gold. Okay, so this chart will tell us whenever gold or the S&P is outperforming. Okay, so what we are seeing here is an ongoing triangle. Actually, it's still some kind of an ongoing consolidation, similar one that we've been talking here back in 2023. So what we were tracking is plenty of ABC structures in this range, and for now that's still ongoing range here. But what's interesting, that this could be a potential triangle. So what we are seeing is a potential bullish triangle, because you can clearly see waves A, B, C, D, and maybe wave E is missing. So maybe in January, February, we could see a little bit further consolidation, but then I think that we are either going to see gold just staying sideways while the stock market will keep pushing higher. And if this ratio will really start to breaking higher, then we will know that stocks in general should be much more attractive looking forward compared to gold. Not to mention that gold made this failure move to that all-time highs, probably because of fear of missing out. So market did not follow through. It came back into the range, and I'm afraid that range on gold will stay in play for a while, and there can be a chance that actually this ratio could really be broken out in 2024. Okay, so if really that would be the case, of course we will know that risk on is going to stay here. Now here's also another chart where we are looking at the S&P 500 versus the 10-year US notes. Now, this is the chart back from 2023. We highlighted the bullish pattern here. So we were looking for S&P 500 to outperform the 10-year US notes, obviously. So we were looking for market to break higher into wave 5. So back then, we assumed that stocks could do really well in 2023. We know that at the start of that year, or yes, through 2022, what we were seeing is that markets was actually being very sideways, and even in this pullback on stocks. So later on, as you can see, stocks recovered. We have seen the S&P 500 that stabilized, and this ratio broke to the upside. And so far, we are still seeing very nice push to the upside here, tracing out this new 5-wave cycle within a higher degree wave 5. So I still think that maybe stocks will try to outperform the 10-year US notes. Of course, the 10-year US notes are now also in a recovery mode, but maybe the stock market will see some more gains here to the upside in 2024, especially if we are going to see some massive breakout here to new all-time highs on the S&P 500. So for now, this chart clearly suggests that the S&P 500 or stocks in general could be much more attractive. Now, let's take a look also on this one. This should be very important, okay? So what we are looking at here is the S&P 500 and the put-call ratio of that S&P 500. So what is actually the put-call ratio? Well, the put-call ratio tells us if investors want to protect themselves from market going maybe to the downside, because they believe that market will crash and they will buy a lot of puts, or maybe they are looking for market to break significantly to the upside and they are buying a lot of calls. But if these puts and buying calls are moving into the extremes, we know that market is overreacting. There can be a lot of either pessimism or a lot of optimism. Okay, so we want to use this put call ratio to trying to navigate the markets from very extreme levels. So if we are seeing markets moving into the extremes and this put call ratio is also the extremes, then this may tells us that the S&P 500 could sooner or later see some reversals as well. So actually here at the bottom, which is a put call ratio, it's actually inverted, okay, because it's much easier to read and compare it with the S&P 500. So for this presentation, I made an inverted scale, but you can see here that at the bottom, this scale is really not easy to read. Okay, you can obviously spot some very interesting but sharp volumes whenever they occur, but sometimes the market is just very noisy here. So that's why I'm using inverted moving averages of put call ratio. Okay, and this is the 5-day moving average, and this one will try to get rid of a lot of noise here. And you can see here that whenever this market has been extremely bearish, of course, the market has been buying a lot of puts because investors were concerned that market will see even more weakness. So what really happened? Well, if that happened, this extreme of buying puts happened in some extended conditions, what happens? Well, the market does the opposite what the crowd expects, right? So that's when we are seeing the bottom and the market rallied. Now, here was also very similar, going back to July of 2022, and then also at the start of 2023, and also here, I think it was October, November of 2023, when there was, again, a lot of uncertainty in the markets. Traders, investors were buying puts, but the market bottomed and continued to the upside. But notice that here we are now approaching to these all-time highs here, but I'm not seeing any kind of a really extreme readings here on this ratio. So I'm not seeing extreme readings or of buying calls, meaning that there still can be plenty of room for this market maybe to continue higher. You can see here where we were at the extremes when going back through 2020 and till end of 2021. You can see that there was an extreme, but market was stable here and still been in uptrend. So in my opinion, because we are still not anywhere near these levels, I think that there is still plenty of room for the S&P 500, maybe even trying to break the 5,000 level at the start of 2024. But whenever we will see some kind of a unexpected, very strong buying of calls, if the market will try to break the 5,000 level, that's when we will have to be very careful and be aware that maybe there is going to be some kind of a pullback. Okay. Also keep in mind on VIX. Okay. What is VIX? VIX is known as a fear index, and if this if the levels are very low, it means that there is very low of fear in the market. So the investors are fine with the current conditions and they somehow believe that market will continue even higher. Well, but keep in mind that whenever VIX, known as fear index, will come to these levels that we can see that represented very important zone of uncertainty, we have to be aware that at some point in the future there will be again VIX that will wake up. It always did. So there will be volatile price action, and normally in uptrends on stock markets, the market is not that volatile. The volatility occurs when the market moves. So in a bear market, it's where volatility actually shows up. And if suddenly, let's say that stocks will drop and at the end of 2024 or in the second part of that year, what we could see is that VIX will actually see a very strong break to the upside, because whenever we see a drop or a reversal from a new all-time highs, that's when investors will again become very skeptical and will go out of their positions, and this is what causes even strong bounce on volatility. And that's why we could potentially see VIX maybe even turning to the upside at some point in 2024. But I don't believe that this will maybe occur in this first part of the year. I just think that maybe in the second part of the year things could be a little bit tricky. Now, if we look at these cycles, actually we are obviously, as I said, at the lower side of these very big ranges. But if we break this upper line of these triangles that always occurred here somehow at the bottoms, that's when we should be very careful and see what the market could bring us. Okay, so if we start breaking and moving back towards 20, I just think that maybe this could be the first indication that potentially we are going to see a new pullback on stocks, and we are not really sure how deep this could be, but definitely just be aware that that's when the volatility could show its trend. Okay, now let's take a look on this one, which is actually commodity index, the Thomson Reuters, versus the US yields versus dollar index. So as you know, this is all very important and very connected. Okay, so firstly, that was our chart that we were already tracking back at the start of 2023, when we were said that correction is in place and most likely we will see even more weakness. And this was also suggested that the dollar will stay in downtrend. Okay, we know that commodities and dollar for now have a very strong correlation. Why? Because obviously lower commodities, or I should say it that way, because commodities in general will define what will be the inflation. If commodities prices are coming to the downside, the inflation forecast will also come to the downside, right? And because of that, there is speculation that the Fed will not be raising rates further, maybe even cut if inflation will come somehow even below 2%. And that's why the US dollar is also then coming to the downside with the US yields. Okay, so if we're looking at this correlation now, well, it's still here And what we are actually seeing is that there is incomplete corrective decline, in my opinion, on these commodities. So I think that commodities still could potentially see, not maybe all of the commodities, but that's a sector in general, could still, these commodities stay in corrective phase and even extend at some point down into this wave C. And if that would be the case, what this means is that dollar will most likely see even more weakness, and that the US yields will most likely stay in this corrective cycle as well, which is my opinion is still in the first part of the minimum 3-wave drop. So I think that the US yields in general will stay weak with the US dollar and because of commodities in 2024. Okay, another market that is very interesting and important for the US dollar are emerging markets, okay? So whenever we are seeing US yields in the US, obviously, coming to the downside, what we are seeing is that investors will maybe try to move US dollar out of the US to some other countries. So if the interest rates, US yields, will come to the downside in the US, there can be movement to emerging markets, so to developing countries, so that countries could benefit from that. And looking at this correlation, somehow correlation between emerging markets and dollar at the bottom, you can actually see that each time when dollar somehow found the resistance, okay, the emerging markets found a low. So a swing low. So what we are seeing here is that actually this recent swing low here in emerging markets has been found when dollar index found the top here around 110. And what we are seeing from an Elliott wave perspective, it's an ongoing ABCDE triangle. And looking at these latest developments that occurred through 2023, I just think that based on a shorter term wave structure, and I have been talking about this a lot and shared a lot of ideas also on Twitter, I think that emerging markets based on the Elliott wave pattern have room for more upside. So they are showing potential strength going in 2024. And this on the opposite side, obviously, it means that the dollar could stay in this downtrend. Okay, so this is also another sector that we will definitely keep a very close eye in 2024. Again, looking at this dollar chart, we also shared this one, I believe, a lot of times on Twitter. But here again, if we just update this one from start of 2023, we've been highlighting these two channels. So back then we were looking for a top here on dollar index at the upper side of the channel that was very similar to this one that goes back that finished here around 2002 or so. So it was not only a very similar channel, it was also very similar in distance. Okay, so back then when we were seeing this reversal happening, we said, okay, dollar has stopped out, we are seeing more weakness going into 2003 and now also most likely in 2024, because the current drop, in my opinion, is still not completed. So I'm looking and was looking here at the start of 2023, I was looking for prices to retrace at least towards the lower side of this channel. I'm not sure if the channel will be broken or will hold. I do not want to be smart here and trying to forecast something I can't. Okay, firstly, I have to see if the market is really breaking the channel or no, and then we could see much probable waves ahead. So looking now here at this current developments, you can still see that we are not at this lower side of this channel. So in my opinion, again, it says to me that dollar has room for more weakness. Also, inflation is still not at the 2%. Okay, yes, there are forecasts that Fed is done with the hiking rates because inflation is coming to the downside. But if inflation will maybe even at some point come below 2%, okay, then who knows, maybe they can even cut potential rates, because obviously if inflation will get too low, they will have to cut the rates to support the economy, because they want inflation to be moving, keep moving here around this 2% level. So it's going to be interesting what will happen whenever we move towards 2%. What will the Fed do? But looking at these correlations, I definitely think that because inflation could return towards 2%, dollar will stay weak here. And also at the same time, I think that Fed funds rate here has topped out. We've definitely reached here, as you can see here in the past cycles, we reached the magical 5% here. So clearly, I think that we will either stay sideways here or even cut the rates, especially if we see inflation coming below the 2%. Okay, now let's take a look on this one. So what's all about? Well, now we have went through some of the big ratio charts. Okay, now all of the ratio charts that I went through suggest one thing: lower US yields, or at least corrective phase for the US yields, lower US dollar, okay, and higher stock prices. Okay, now on stocks, as you know, there can be volatile and you will definitely see the pullbacks, same with the US dollar. But general picture for the US dollar suggests, at least to me, that the dollar will stay weak. Keep in mind that the Fed is one of the first banks that forecast potential cuts for 2024. So investors are looking at that numbers. And we have on the other side of that, we have other central banks that are lagging, that like ECB, who is still hawkish and should remain hawkish. Okay, so with that kind of a central bank policy divergence, what we are seeing is that actually a lot of other currencies could outperform the US dollar quite well through 2024. I'm not saying this because of those central bank policy decisions, okay, but I'm also trying to link this because of the Elliott wave charts that I will show you later in a second. But here you can see that these FX correlations, okay, here at the top we have the FX correlations. Compared to the S&P 500, compared to the US yields, compared to the US dollar, you can see that since that goes back to October of 2022, okay? Now, since then, because back then, that's where we have seen this dollar index top. And since then, you can see that actually Kiwi, Aussie, CAD, Japanese yen are not doing that great compared to maybe euro and pound, okay? So commodity currencies, when you look at the higher degree scale, okay, commodity currencies did not good so well. Mexican peso was different story because of the higher interest rates, okay? But the reason why maybe commodity currencies like Aussie did not do well, why? Because we had these issues with China, which is still not cannot pick up, and that's what is holding the Aussie back, and other commodities as well. But what is really interesting is that now look at this red line, okay? That's the line since the S&P 500 from start of November started to move to the upside, since the US yields moved to the downside, since the US dollar also joined this weakness, is since Fed gave us the first indication that they will most likely end the hiking cycle. And since that point, you will see in the next chart that commodity currencies like Kiwi and Aussie are now trying to fight back. Okay, so now this chart goes back to November from that point, okay, when Fed gave us indication that they could be done with the rates, with hiking rates. And since then, you can see that Kiwi is now trying to outperform. It's trying to get back what it lost before, okay, and Aussie as well. So in my opinion, if dollar will continue to weaken through 2024, I think that Kiwi and Aussie could really be a very interesting and strong and could see a very strong moves going in 2024. Of course, Mexican peso, euro, pound could also do well, but somehow I really like the commodity currencies, especially if maybe China will also try to pick up. I think that those commodity currencies will do really, really well. Okay, so now we covered this first part, the ratio part, and now we will also look at some of the assets where I will look at the wave count. So here you have these listed assets that I will cover now in a second. Okay, now the first chart I want to take a look at is obviously the US yield. Okay, so the 10-year US yield shows me that we completed this 5-wave cycle. So whenever you have this 5-wave cycle finished in Elliott wave terms, what you would expect, an ABC correction, okay? Because impulses or directional trends that are very strong are made by 5 waves without overlaps between between wave 4 and wave 2, which clearly has been the case here. And now, so that was an impulse, and now then even if we are in a temporary corrective case here, what we should see, a 3-wave movement to the downside, because corrections on the other hand are made by 3 waves, and so far that's still only one leg from the highs. So wave B and wave C are still missing. So even if at some point in the future US yields will stabilize, for now they should remain bearish until we see these waves B and C to the downside. So what it means for the US dollar? Well, if the US dollar is already very weak now, which by the way have seen lower high when the US yields made higher high, so it means that if very strong market, the US yields is now turning to the downside, that very weak US dollar will become even weaker. So I'm definitely looking for US dollar to break below that levels that we have seen earlier in 2023, and then we could potentially even extend towards around 97, 98. Okay, so for now the US yields shows completion of a 5-wave movement and ABC correction in play, but of course there will be some pullbacks always, and be aware that maybe wave B here could still unfold in the first few months of 2024. Okay, now let's take a look also on dollar index itself. So what we have here is a daily chart. Okay, so here we have very nice 5 waves down, so that's an impulsive decline, followed by waves A, 3 waves move to a new low, so I think that's a wave B, and very sharp move to new high here above wave A, I should say, it's wave C. So it's called a flat correction, where wave B moves beyond the starting point of wave A and where C moves beyond the ending point of wave A. So what we are seeing later on is a very strong and significant reversal, which normally will be the case because this kind of a flat corrections, irregular corrections, are very hard identified, especially from traders that are not focused on the markets and patterns from Elliott wave perspective. Okay, so what's the most important right now is that we have lower highs and lower swing lows here within this current decline. So I think that this current leg down is acting impulsively. It means that it will most likely extend even lower after any pullback. So after any kind of a rallies that we could see maybe through January, I think that this could be opportunity actually to join this current weakness that in my opinion could take us, as I said earlier, towards 97, 98 targets, which are my minimum FIB targets based on the latest developments. Okay, now also if I want to take a look where is the 200 moving averages is around 99, so definitely that's maybe the first target, but since we are falling quite aggressively here, I would not be surprised if we see even lower prices than that. Okay, now let's take a look also on the euro. Okay, so if you are my follower on Twitter, you know that I send out a special article for one newsletter, and I specifically discussed about the euro dollar and trade differential between European yields and German yields and the US yields, and I highlighted potential bullish flat correction. And so far, and this article, by the way, has been shared in the first few months of 2023, and so far we can see that this flat correction is really coming into play. Actually, it's already finished in my opinion. So firstly, we have seen a very nice impulsive recovery here from that low. So I think that the multi-year low here has been put in place on the euro dollar, and that we are now in a new stage of recovery that will take euro dollar much higher. So this was the first impulse. And now through 2023, we somehow have seen volatile price action, and that's what is called a correction, because we haven't seen any kind of a breakout. So again, it was obviously a flat, similar but opposite to dollar index that we discussed earlier. So what we are expecting now is a new resumption higher here on the euro dollar, because I think that this corrective stage is finished and that the euro dollar is headed much higher. So after pullbacks, I think that the euro dollar is headed much higher. And keep in mind that the ECB is somehow more hawkish compared to Fed, obviously. However, at some point, as we know, even other central banks can catch maybe the Fed, and this could potentially cause some pullbacks here, but still opportunities on the way up, in my opinion. And what is the most important is probably here, the German US yields differential. So what we have here on the top is German minus the US yields, okay? So if this ratio goes up, it's positive for the euro. So that's the most important for you now. So whenever here we have seen that this ratio has moved to the upside, we have seen that the euro dollar also recovered. Why? Because it means that the US yields were falling much faster compared to the yields in Germany, okay? And if you look here now, the past occasions, of course, we have always seen this outcome that the euro dollar somehow bottom tried to stabilize whenever this ratio also have seen a reversal. And what we are seeing right now here at the end of 2023, we are seeing that ABC formation here is sending the ratio into very interesting potential support. So I think that if we are really going to see a bounce here, that the euro dollar will see much more upside, because it's already showing strength from the past few months, okay, when dollar index has moved to the downside. So I think that the euro is already in a very good shape now, but if this maybe US yields will even accelerate to the downside because of central bank policy divergence between ECB and the Fed, I think that this move to the upside on ratio will be very explosive and can be very supportive here for the euro dollar, which could also at some point maybe break this multi-year trend line resistance. So I'm very bullish for the euro dollar, and I'm expecting much more gains going in 2024. Of course, there will definitely be some kind of a pullbacks in the meantime. Now let's take a look also on cable. Okay, now cable, I also think it reached an important low here. Going back to 2022, we have seen a very strong capitulation back in September of that year. And as you know, everyone was so bearish in pound, and what has happened? Well, we have seen immediate, very strong reversal. And I remember that very well. We were tracking this price action quite closely. And what we are seeing so far is potential wedge formation. So we bottomed at the lower side of the wedge. So my expectations were that we, at least at some point, we will move towards the upper side of the wedge. So we are now very close to this area where I will potentially observe the breakout point, okay? Because I think that this recovery here on cable is very impulsive, very strong one. That's why I believe that after this consolidation that we have seen here through second part of 2023, I just think that we will potentially trying to take a breather and eventually see even a break out of this wedge here. So I think that the more upside here is possible on pound, especially obviously because of the weak US dollar. Now let's take a look also on Aussie. Okay, so Aussie, firstly, longer term chart. Well, each time after the recession has occurred, we have seen Aussie that recovered very significantly. And this has occurred with 3 waves. So in Elliott wave terms, you would expect an ABC structure after the post-recession lows. But what we are seeing right now, still going back from 2020 recession when we got this COVID-19, was what we have seen only one leg to the upside, a pullback. So the third leg is still missing here. So I'm expecting that Aussie at some point will still trying to get back on the road and maybe trying to catch some gains here, especially if maybe China will try to pick up as well. So I'm thinking about more upside on Aussie going in 2024. Also from an Elliott wave perspective, I think that we have some very interesting pattern here. We have very strong move to the upside, and then we have some corrective price action because of overlaps here back into the 61.8%, okay, of this very big swing. And now we had also another pullback which has been in 3 waves for the 78.6%. And what's important, this held very well, and we are now even seeing the prices breaking the trend line. So based on the minimum expectations, when looking at Aussie, I think that we are in the third leg of recovery. I will not say that this is going to be a very strong wave 3, because I know that can be only wave C. So what are the minimum targets is the most important for me based on both interpretations, wave C or wave 3. So the first target should be at 70.2560 or 50, around there. So that's where wave C would be equal to wave A, okay? So I think that there is still plenty of room, as you can see here, for Aussie strength. And as I said earlier, it's also very important to see how the China will do, or maybe we can take a look at Hang Seng Index, which should be here. Okay, so Hang Seng Index here, as you can see, is also somehow in a very deep, potentially corrective phase because of overlaps. We bottomed, potentially not bottomed, but found a support at the 78.6%. But if we can break firstly this trend line and maybe then another one for 2024, I just think that much more upside here could be in the cards. Now in Elliott wave terms, I certainly think that we could be trying to build a base here. Okay, so more upside here on Hang Seng Index would be positive for Australian dollar. Also, Kiwi could do as very good as well. Here we are tracking a multi-year ABCDE triangle, but again, sometimes triangles can be very tricky, can be very bullish, can be very bearish. So it's very important to be flexible as long the price is trading and ranging between these two important trend lines. It's totally different story when you have a confirmed breakout. But for now, that's still ranging price action. But even in a ranging price action, you can focus on some key levels. So what we are seeing here is that prices in 2022 and now in 2024 are reversing away from the lower side of this pattern. So if you think that market has bottomed at the lower side of the range pattern, what would you expect if market is ranging? Well, that the upper side of the pattern of this range will be tested, right? So in such case, I would be expecting that Kiwi will see more upside and potential strength towards 6650 area. That's going to be then a key level. Whenever we are breaking out or no, that's from the market to decide. But I really think that it could still be some very nice opportunities on the way towards this trend line, and then let's see if the breakout will occur or no. But I think that for now, that really looks like a nice potential price action that suggests more upside here in at least at the start of 2024. Okay, now let's take a look on dollar yen. Now dollar yen, as you know, has been very volatile this year, mainly because of speculation that Bank of Japan will change their policy in 2024. They are certainly going into this direction, but there can be some very tricky still price action Japanese yen, especially if Bank of Japan will not deliver what market expects. But still, looking or combining the Bank of Japan projections and speculations by investors, and maybe looking at the US yields and the US dollar, somehow this tells me that the dollar yen will either stay in a range or even bearish. Now, from an Elliott wave perspective, we could potentially complete these 5 waves up with a double top formation here at the recent around 151 levels. What we are seeing so far is a very nice and strong move to the downside. So we have also US yields coming to the downside, US dollar is coming to the downside. That's bearish for dollar yen. And if Bank of Japan will also trying to join this current movement by changing the policy, the Japanese yen will see much more upside. But maybe the reason why they could be trying to hold back for a while now is because they know that whenever they take any kind of action, markets will be very volatile. And I think that the Japanese yen could see much more downside here going in 2024, potentially even back towards 130. I'm not sure if this will be wave 4 or maybe still some kind of a complex wave 4 that is already in progress, or maybe part of a new bearish trend. I don't know, but for now what I know is that we are seeing the temporary top in place and that there is room from 140, I think, down towards 130. And now let's take a look also on crude oil. Okay, so crude oil, as you know, is very important for inflation. So back in September, when we have seen this crude oil in 2023, in September, when we have seen a significant rise of crude oil, what happened later on with the inflation data? Well, a month later, we had inflation again ticking higher. So that's when dollar again turned to the upside. So now crude oil and US dollar are somehow in a positive correlation because of the inflation expectations. So if you're trading the FX, just keep in mind that dollar and crude oil are not in the perfect correlations like there have been before, because you have the major inflation data that is trying to drive these prices around, okay? And obviously the speculation or forecast of inflation, okay? So from an Elliott wave perspective, what we are seeing, we said earlier that commodities are most likely going to see even weaker prices for a correction. Looking at the crude oil at the energy market here also suggests that we will see weaker prices. I'm not really sure if wave B is already finished here or no. This is going yet to be defined and decided by the price action that I will see at the start of January, okay? But overall, I just think that even if we see unexpected recovery here for a higher wave B towards 90 or 100, I still think that there will be opportunity on the short side and that crude oil will see much more weakness. I think that some very interesting or value would be between $40 and $50 per barrel, okay? Another thing that we should potentially track is if we really are going to see break to the downside on commodities and crude oil prices, then you definitely have to keep in mind on these US crude oil reserves. Okay, that's the chart at the bottom. So whenever we are going to see crude oil much lower, I'm sure that US will be looking to fill their reserves because at the lower prices. So at such point, and then obviously they want to sell crude oil at higher prices. So whenever you are going to see crude oil maybe potentially coming back towards $50 per barrel, what could happen? Well, if the US government steps in and trying to fill their reserves, of course, this could potentially trying to stabilize the prices. So it's going to be very important to track their forecasts and expectations from the US government regarding their reserves for sure, okay? But generally speaking, I think that the crude oil is in a corrective phase here, higher degree but still this corrective phase is incomplete and will most likely see more weakness. And now let's take a look also on gold. So here we have a gold, actually it's a yearly chart, and you can see that potentially we have waves 1, 2, 3, 4, 5. So very longer term speaking at gold, keep in mind that there can be a wave 5, but still there can be another very still room for another 10, 15, 20% movement here if we break this recent recent event when gold moved to new all-time highs and then immediately turned to the upside. If we can break that level, then I think that gold could potentially see a very strong move close to 2,300 or so. But generally speaking, I think that gold is in a fifth wave. Okay, so I'm not really sure if gold is one of the best opportunities going in 2024. I was very bullish on gold, expecting much more upside in 2023, which has definitely materialized. But now when we reach that levels, I just think it's better to be careful rather than be surprised. So just be aware that maybe gold prices will try to stabilize or will move to the upside very slowly. I just think that silver could be much better compared to gold, not only because of its wave pattern, but also because historically gold silver ratio suggests that silver is can be much better investments when metals are in uptrend. But here, looking at gold, firstly on a monthly chart, you can actually see that not only we have 5 waves up on that big scale, we can also potentially count 5 waves up within this wave 5. Okay, so the latest leg is not really completed yet. Maybe this one will unfold as somehow as a ending diagonal or something, because I really do not like how the price action recently unfolded. Whenever we have seen this move to new all-time highs spiked out, a lot of traders wanted to join this breakout, but then immediately market came to the downside for 150 bucks or so. So I think that gold could potentially stay sideways, or even if we'll see more upside, it can be very slow. So as I said, I really like silver much more here. If there will be something uncertain, if there will be some uncertainty in 2024, still I think that silver could be very attractive. Of course, even gold could see much more upside then, but I think that much more upside potential here have silver. Now, from an Elliott wave perspective, we have seen a very nice and strong move here from March 2020. It was a very strong move to the upside and then sideways consolidation here. And this consolidation looks like a triangle. So I'm not really sure when this triangle will be finished, but certainly suggest that the next break again should be in the same direction like the first leg. So I will be looking for more upside here, potentially even towards $30, $35 here on silver for 2024 whenever we see this breakout. Okay. Also, there can be potential head and shoulders bottom formation. So the real breakout point could be here or above 26. So if you see weekly closes well above 126 above $26, then I think that potentially head and shoulders pattern would be actually as finished and the breakout could be underway. Okay. And now finally, let's take a look on the S&P 500 and DAX. Now, firstly, the S&P 500, looking at the first chart, we are already seeing prices trading at all-time highs. But still, I try to be very careful here when trying to predict, and not trying to predict some kind of a crazy long-term targets. I want to look at the markets more for what may happen or unfold in the next few months. I can still adjust my views whenever time progresses with the price. So what I'm seeing here is very nice push to the upside here from the last few months. Okay, but this still can be potentially corrective wave B that can belong to a higher degree wave 4 correction. Now this wave 4 correction could later on unfold as a triangle, as a flat, as some other complex pattern, but the idea here is that this wave 4 degree can belong to the same wave 2 degree here, which as you can see has been very long in time. So that's why I'm wondering if maybe wave 4 could be the same degree, then obviously we should be aware of something more complex here. Okay, but what's good about this interpretation is that I'm very conservative here, but still I'm expecting more upside, at least at the start of 2024 or in the first 6 months. Why? Because this wave B is incomplete, and in flat corrections or irregular corrections, you have even room for 138.2% extension of wave A. So these targets are still far away, and there are around 5,300 or so. That's another wave. That's the first wave count. Another wave count is that potentially we are still in the middle of an extended wave 3, very big wave 3, where we had this extension that is going on from 2009 lows. We have the extended first leg, okay, and that was then the wave 3. Wave 4 did not overlap wave 2, which is good, and now we are in wave 5. So this one is also bullish wave count and suggests that we could be rallying towards 61.8%, which is around 5,100. So even this interpretation suggests that we can see more upside. Where would be this wave count invalidated? Well, definitely here above 6,100, because wave 5 must not be longer than wave 3 if wave 3 is already shorter than wave 1. Okay, hope that makes sense. Okay, so for now it's still a very valid wave count and it shows room for more upside. Anywhere, targets can be anywhere between, as I said, 5,100 all the way back, all the way up towards 6,100, but not above that, because wave 3 would then be the shorter and the wave count would be invalidated. And if that would happen, we would have the massive movement here to the upside, most likely happening on the S&P 500. So for now, I'm looking at two wave counts. Both wave counts are correct for the moment, and both wave counts suggest that there can be more upside in the first 6 months 2024. But you have to be aware of some pullbacks, okay? Why? Because I still think that these major levels here around these all-time highs are very important. Everyone is watching these levels. Also keep in mind that we have end of the year flows and then start of the new year flows. So this is very important because a lot of portfolios will be adjusted in this range. Either they will be looking to close their longs because of profits, or they will leave long stocks through the new year and they will book profits in the start of the new year to avoid tax. Or maybe some will cut their stocks here for the end of the year because they will actually try to lower the taxes with some of the losing positions and so on. So it's very important to be aware that markets can be very volatile at the end of the year and at the start of the year. So these position adjustments around portfolios could potentially cause a new very interesting volatility and new change in price. Okay, what that means is that potentially, who knows, we could even see some kind of a pullback. So even in this Elliott wave terms, where it's said that wave B movement to the upside can be corrective, well, if that's the case, you still have some room for this recovery to continue after a pullback, because then we have potentially this ongoing 7 swing recovery. So that was the first free wave movement, wave X, that connects the second free wave movement that is in progress. And you can see that here, this first part, okay, W has been in play for 189 bars. And I'm projecting also similar length here and see that there is even room for this recovery to August of 2024. So markets can be slow here to the upside, but still plenty of time for a recovery towards this 5,100, 5,300 area. Okay, we highlighted this 138.2% as a very important level. So I think that there is room for more upside. But as I said, we need 7 swings here into this area. And for now, that's still not the 7 swing move, okay? So there is room for more upside, but in the middle, there will be pullbacks. So I'm afraid that maybe new pullback may not be that far away. Looking at this seasonal chart, okay, you can actually see that this seasonal charts shows that January is usually a very bad month. Okay, you can see some very strong pump and very interesting movement at the start of a month, and this could be because of this position adjustment, and then you generally have seen a pullback. So maybe the January will not be will not provide any solid gains for stocks. We'll see. Of course, that's not always 100 correct, but certainly it really can help, especially if you have maybe the Elliott waves and your cycle analysis suggests that we could be running into some interesting potential reversal zone and that we could see a pullback. Then that's definitely something that worth to keep an eye on. So if we see kind of a pullback, whenever we see a pullback, I think that there will be still opportunities on the stock market. Okay, so even if I'm tracking currently as a primary idea wave B corrective rally to new all-time highs here on the S&P 500, it still doesn't mean that I'm bearish. Okay, I'm still bullish within the current sequence. Okay, and if price will breach my levels around 5,300, no worries, we will adjust the wave count to the second wave count that I showed you earlier on the monthly chart. Okay, so the S&P 500, in my opinion, still bullish in a risk on mode. Just be aware of these potential pullbacks that could maybe kick in and occur in January. At the same time, dollar could also see obviously some kind of recovery. Now let's take a look on German DAX. Now German DAX, looking at first monthly count here, we could be looking at a very nice impulse here. Not really the best perfect example of an impulse, but still you have higher highs, higher swing lows. So definitely I want to label the wave count within the uptrend, of course. And I'm seeing prices at the first 61.8%, but the much more interesting and upper targets longer term could be around 20,000. Okay, so 17,000 is the first resistance. But now if I try to hide these labelings, what you will see is that actually we have some very interesting price action here as well, some overlaps. Okay, so I'm even trying to look at another wave count here, which shows that potentially this could be an ending diagonal, but I will not say that ending diagonal is at the end and that we'll see now immediately a top of a fifth wave and we'll see drop, but maybe we are at the end of a wave 3 and we'll see some pullbacks at the start of 2024 and then more upside into the wave 5, because I never want to say and trying to call a top if I have much better different options with the wave counts to stay with the wave with the trend. So my primary idea whenever I look at the markets is trying to label the wave counts and stay with the direction of the trend if the Elliott wave rules allows me to do so. So even if that's an ending diagonal, potentially, I'm still expecting a bit of more upside, but just realize that there can be corrections and pullbacks within this current wedge that can be unfolding. So looking at German DAX, yes, it's bullish, but I somehow think that maybe US stocks could be much more maybe interesting, attractive compared to the one in Europe. Okay, now finally let's take a look on Bitcoin. Okay, so Bitcoin, here is maybe the best and easier interpretation of what potential bull market here on cryptocurrencies or Bitcoin in general. So each time from 2013 there was an interesting pullback of around 12 months, or in one occasion even 13 months, which nearly we can say around 1 year of a pullback has normally occurred on Bitcoin. And after this time of a pullback and pullback of a 70 to 80%, what we have seen is that market moved to a bullish phase that lasted for around 3 years, 35 months. Okay, so if we compare, this has been the case, as I said, for 2014 and 2018-19, we have seen the corrections, and then the bull run lasted from 2015 to 2018, and then again 2019 to 2021, and now again this has been a pullback going into this end of 2022, and we are, looks like, in a new bull run. And you are still in the middle of this 3-year period. So what that means is that there is still plenty of time for Bitcoin to recover. And maybe we will even see a move to a new all-time high. So looking at the Bitcoin, the wave count itself here, well, I'm tracking potentially very big 5 waves up on this monthly scale, with 5 sub-waves unfolding within this 5th wave. So even if I think that we could be running into 5th wave of a 5th, there still should be seen a new high. Okay, so I think that the more upside here is certainly possible on cryptocurrencies, especially if US dollar in general will stay in downtrend. However, there is some very important price level that we should watch for. Let's say that I'm wrong, and let's say that cryptocurrencies will see a move to the downside, that something awful will happen in 2024 regarding regulations, ETF launch, whatever. Okay, and then if the price suddenly comes back to the downside, and if it breaks 24,000 and 400 levels, then I really think that Bitcoin would be in trouble, because in such case, break of this level, okay, and break of that trend line at the same time would most likely suggest that this current rise, okay, from 2023 lows has only been 3 waves, and that market is headed back to the downside. So if we see this level, this price level broken, be aware of potential corrective price action or even bearish price action in Bitcoin, because then I would most likely adjust the wave count and look for this drop to be in 5 waves as start of a deeper correction rather than end of a wave C of a flat correction here for a wave 4. So for now, Bitcoin is still in a very good shape because of the US dollar and because everything what's going on. I think that more upside could be seen. But if suddenly, let's say that I'm wrong, which obviously can happen, and more price breaks below this trend line and below 24,000, then just keep in mind that something else can be unfolding on Bitcoin, and you could see much more better and even attractive levels than in the future. Okay, traders, so finally that has been the final asset that I covered for this video. I really hope that you enjoyed this interpretation. So once again, I invite you to leave us the comment below this video, to press a like and be in the contest for 1 month of membership or of a monthly or 12-month package. So definitely I will announce the winners later in January. Traders, thank you once again for your attention, and I hope that you will have a very interesting and profitable 2024. Have a good day. Bye.